Welcome back to another episode of In Focus with Haversine Funding, the podcast where we discuss trends, insights, and strategies that drive success within specialty finance. I'm your host, Nolan Reichert. I'm joined by my very familiar co-host, Jeff Whaley. Jeff, great to have you back.
Thanks for having me. It's been a while.
Yes, it feels like it has. And today we have a very special guest, Jim Cretella, partner at Blank Rome.
Thank you for having me.
Thank you for joining. Jim has represents factors, asset-based lenders within the space. He's been in specialty finance for a number of years, but I thought you would be a great guest to have on because you have a very unique seat from what you see. Yeah. You get to see disasters and success stories before and after. Very involved in that. So I thought we would kind of pick your brain a little bit about what you're seeing, some lessons, some takeaways that we can have in there. So I figure we go through a few different topics, trends, and then kind of jump into some situations as well, from real life situations. So kind of to kick us off, what are you seeing, from a trend perspective that feels meaningfully different in 2026? I know it's very early on, so in 2025, beginning in 2026, than you have in, this previous year.
Well, I think it's an interesting market right now. There's clearly, with some borrowers, distress, right? Mm-hmm. Underwriting standards have tightened, more distress. But I don't think you can really say it's a trend across the industry. I think it's more borrower specific or transaction specific. There's a lot of opportunity out there, a lot of junk out there. I think a lot of it is fueled in part. Banks are holding on to things a bit longer than they were. So that trickles down into specialty finance. By the time the banks will, kick out the credit or let the credit go, it's probably already a bit of a stretch for some of the private lenders and specialty finance. So I think you're seeing a bit of that. With underwriting and credit tightening, there's more opportunities out there. But again, there's problems. The problems are borrower specific. So I think what I'm seeing this year as compared to last year is there's opportunity, but you also have to monitor and look at the transactions on a bespoke basis as opposed to a more macro basis.
Yeah.
Well, keeping that in mind about borrowers specifically, that's more of a transaction-based issue. Let's look at lenders specifically. Are lenders behaving differently recently? Are they more aggressive, more complacent? How would you describe lender behavior now as opposed to 24 months ago?
I think both. Some lenders are more aggressive. Some lenders are pulling back the reins a bit. I think it depends on what your risk appetite is and where you are in the market. Right. I think from a lawyer's perspective, where we get concerned is when we see the lender who tries to be everything to everybody.
Yep.
Right. That's usually the problem, what we see. But, you see some of the more, what you'd expect. You see the banks, some of the more conservative lenders, pulling back the reins a bit, stronger underwriting, stronger credit. Some of the specialty lenders are looking at this and seeing it's more of an opportunity because it goes back to what we talked about before. If the banks are holding things a bit longer, they're usually going to be stretched on the advance rate, stretched on liquidity. So if you're a private lender in that space and you have the ability to work with those types of issues, there's a lot of opportunity there for you. Now, whether you're conservative or aggressive on that, that's a matter of preference, but that's where the opportunity is. And hey, look, whenever there's an opportunity, there's a way to do it.
Mm-hmm. Given that you're seeing those opportunities, if you look at what the work you're doing right now, is there anything you're seeing more often now than you saw as far as things that are taking up a lot more of your time now than would have taken up maybe 12, 24 months ago?
Yeah. So I think from my perspective, I see two things, maybe three things. Number one, especially in the lower end of the market, the factors, the lower market ABL lenders, things are going bad in some deals. Not all deals go bad, but a deal that goes bad, it's not a slow burn. It is, right? And it's usually, it's a fraud or there's fake invoices or these guys just run out of money overnight. So in the lower end of the market, we're seeing those types of things happen very quickly. And it's in part because those lower market companies, those lower market businesses, they're squeezed, right. They're tight. Right. And when their back is against the wall, they're going to borrow from the lender or the factor. They're going to redirect the collections, things of that nature. And we're seeing that stuff happen overnight. In terms of the more upmarket lenders, the banks, First Brands scared a lot of people. First Brands has made some people.
We'll talk more about that one here, I'm sure. Oh, yeah.
Look at their underwriting, look at their procedures. So, even on deals that really have nothing to do with the First Brands, industry, anything like that, you're getting questions from the underwriting committee, from the credit committee that are, I would say, First Brands adjacent. What's our diligence like? What's our backup like? What are we doing for this? So you are seeing that. I think another trend I'm seeing is, especially, again, not every transaction is a distressed transaction, but the ones that are, it's not really a bankruptcy. I mean, First Brands notwithstanding, most of the distress and the workouts we see are outside of bankruptcy, right? So if you're adept at maneuvering that process, there's a lot of opportunity there for you too.
Mm-hmm. When you're seeing, like you mentioned, deals that go from good to bad, like overnight, obviously, I think one of the things we talk about in our space a lot is the proliferation of MCAs, merchant cash advances. Do you feel like that is a contributing factor, or has that always kind of been the case in the space? Is that becoming more of a factor than it has been in the past?
It's a contributing factor. I think that MCAs put gasoline on the fire, right? For lack of
course,
yeah. Look, it's a symptom of over leverage in the lower market. That's what it is. I mean, interest rates are still up relative to what they were, 10 years ago. Leverage, expansion, and then we're pouring gasoline with the MCAs doing deals that nobody else would do, which, puts further leverage on the company. So that is a big problem. In terms of, I don't know if we want to get into the Texas legislation.
It's probably a good time to actually talk about that. Yeah, definitely.
So Texas recently enacted a law that's aimed at some of the merchant cash advance lenders in that industry. And what the Texas law does is, at a high level, not only does it require them to register, to disclose, but it does two things, which to me are really going to be an impediment to that industry, or at least curtail it. Number one, it prevents the MCAs from debiting a bank account of the borrower unless they have a first priority security interest in that bank account. So at a minimum, that would mean they have to go out and get a deposit account control agreement on that account, which quite frankly is not in their DNA. And sometimes the account already has a control agreement in favor of somebody else.
Sure.
There's also a legal question as to whether they could even get a first priority lien, because even if you have a deposit account control agreement, the depository bank still maintains its priority position for bank charges, bounce checks, things of that nature. So there's a question of whether they can even satisfy that. The other unique feature of the Texas legislation is that Texas, like I think Louisiana has a similar statute. Texas has a statute that says, hey, look, if you call it a sale, then for usury purposes, we're going to treat it like a sale. And that's great for factoring because, if you call it a sale, you avoid the usury statute. So the Texas legislation that merchant cash advances said they don't qualify for that statute. So not only are they unable to debit for the bank accounts, but they no longer qualify for the exemption from usury, right? Yeah. So that's going to be a tough hill to climb for merchant cash advance lenders. And interestingly, the legislation is not on its face limited to merchant cash advance lenders who are Texas based. It tries to go after anybody who
the jurisdictional questions about this one are going to be are going to be incredibly.
And I don't
want to dwell on it too much, but I mean, obviously there's jurisdictional questions. I think there's a lot of impetus to do something a little bit more federal as opposed to state by state. I mean, this may be a hard thing to opine on, but do you feel like this is because obviously we're talking about Texas is a huge state. There's a lot of business activity. Is this something that would potentially have potability to other states enacting something similar, or potentially incorporate as part of a federal legislation?
I think you're more likely to see other states adopt it on a state by state basis. I mean, heck, it took 20 years for the UCC to get adopted, right?
We talked a lot about the UCC with
Bob Zadek.
With Bob Zadek, yes. So
I'm not optimistic of a uniform rule on merchant cash advances, let alone a federal rule. But I do think you'll see states adopt similar versions of that statute. Yeah.
Awesome.
Yeah. Try to touch on that a little bit more. What do you, if you had to put your prediction hat on, what do you think the trickle down, like the immediate and then long term trickle down, is going to be?
I think, look, lawyers are very creative, extremely creative. So I think that there will, the first thing that they'll do is they'll try and figure out a way around it. Now, what that is right now, I have no idea, but lawyers are very creative. They'll try and figure out a way around it. Then somebody's going to test it. and there's going to be a test case that's going to run through the court, and we're going to see exactly the reach of the Texas statute. And, by the way, there's no private right of action under the Texas statute. So it's not like, Haversine, if you get dinged with them, it's not like you can sue the merchant cash advance lender on that statute. The state has to do it.
Right.
So it'll be interesting to see how they apply it in practice, but there will be a test case, my guess is.
Yeah, I mean, it's all about the enforcement
Yeah.
mechanism. You can pass as many laws as you want if you don't have a mechanism for enforcing it. Yeah, so I think really what's going on with the rulemaking body at the OCCC, which should be pretty fascinating over the next few months.
Yeah.
Right.
Stay tuned.
Stay tuned.
How soon?
Definitely.
Yeah. Kind of switching gears a little bit, from a lender perspective, what are you seeing right now? Something that lenders may be underestimating.
I think lenders are well, it depends what market you're in. I think in the down market, lenders are underestimating the lengths to which their clients will go to stay alive. Right? Like,
Sure.
Yeah.
just because the document says that the borrower should not do something, can't do something, believe me, doesn't mean they won't.
Right.
In the down market, those companies tend to be family-owned companies where the CEO, CFO is, Uncle Bob and his brother John, right? They will do whatever they have to do to stay alive, even if it means taking your money contrary to the contract, going and, double pledging receivables. They'll do that. In the up market, where you tend to have more, let's say, disinterested, independent people running those companies who may not be or are not as willing to put their, go to jail for fraud or something like that. They're more sensitive to that. You don't see as much up there. So I think in the down market, lenders are often surprised at the lengths to which their borrowers will go, notwithstanding what the contract says, right? I think in the up market, what you're seeing is there's a lot of pressure. There's a lot of competition amongst the banks. It's a very competitive landscape. So you're seeing pressure, put money out on the street, but let's not take risk. Right. And that's kind of that's tough to do. So a lot of those upmarket lenders are struggling with that, and they're getting pushed by private credit as well. So the bank lenders get pushed by private credit because private credit now is both in the down market and is actually pushing into the up market against some of those bank deals.
Yeah. Okay. Funny. I actually have an Uncle Bob with the brother John. An Uncle Bob and John. They don't run a company.
Hopefully they don't run one of those.
Yeah, they do not. They do not. But you said those names, and I was like, I know them. So another prediction, just, I love to kind of pick your brain on trends. You get to see a lot. So you're a very smart guy. So how do you see the industry growing or shrinking this year from a, like you touched on, bank or smaller market? Do you see a lot of growth this year? Do you see things just kind of being stable?
I do see growth. I think there's going to be a lot of growth this year. ABL, bank money, there's more money on the table. Private credit money is still pouring into private credit, right? So I do think there's going to be a lot of growth this year. Another trend I'm seeing recently is there seems to be more M&A activity within private credit. Now, whether the portfolios that are up for sale are good or not, different story. But there seems to be an uptick in M&A activity in the private credit market.
Yeah.
Well, I think this actually, you kind of hinted at, this is a probably good time to switch over or just talk about fraud specifically. I don't want to have an attorney on and not at least get into the fraud topic at some point. Again, we're talking about trends. How is fraud looking different now? I mean, is there anything, like, especially with the advent of AI, or is there anything that fraud just somehow feels different than it has in the past, in case you've seen?
I think it feels different. I'm not so sure it is different. If that makes sense, right?
It does.
Look, when things are going well, it's like playing the stock market, right? When the stock market is increasing and the economy is booming, you could bet on light piles of money on fire.com and it would go up. It just would. So fraud's kind of the same way. It goes undetected when things are going well and people get away with stuff. When margins tighten and liquidity tightens and you're over levered, you see more of it. And then you introduce AI that is, frankly, it checks patterns and it can catch a lot of those things earlier. So you're seeing it more. I don't know that it's necessarily more per se. It's just, it's easier to catch right now, and you're seeing more of it because people are looking.
Now, do you feel like, especially one of the concerns we've talked about before is a lot of private credit money coming in, do you feel like there's early warnings that people are missing? Sometimes it goes from good to bad overnight, and there's just not a whole lot you can do. But in the underwriting processes or even the monitoring, is there things that you feel like people are missing that, if they just seen that red light blinking on the control panel, they would have noticed there was a problem? Is there something that we're missing potentially?
I think, and this might be a segue into First Brands a bit, right?
Yeah.
Private credit, perhaps more so than the banks, like algorithms, like the analytics, like the AI. I think when you blindly rely on those types of things, you can miss the blinking red light on the screen that says, don't do this. Right. So, private credit, I think, needs to find, I don't think there's a fundamental flaw with private credit. I think it's more private credit needs to find the equilibrium between automating the underwriting process and making sure there's enough human element in it so that you do see the blinking red light that the AI might otherwise miss, right? One of the problems, or perhaps the biggest problem in First Brands, a lot of the AR purchasers, no question about it, we all know that they're stuck with billions of dollars in losses. But I think all you really need to know about that is 2-3 weeks into the bankruptcy, the AR purchasers are standing in the bankruptcy court and they still don't know what they bought. They still can't hand the judge a list of the invoices and say, this is what I bought, right? It goes back to the diligence. Their algorithms, their underwriting made the decision that they didn't require those invoices, or they, whatever the reason, they let it go.
So aside any kind of verification happening.
Well, I mean, I think that they might have had a different view of verification at the time.
Yeah.
So before we get, I want to talk about First Brands. So just to give our audience that may not be familiar with First Brands, can you give them a high level overview of First Brands, and then we'll kind of dig into what went wrong, some lessons that lenders can take away from.
So First Brands is one of the largest bankruptcies of the last year. What makes it, I think, very interesting for lenders is that it involved a lot of different lending products. It involved private lending, it involved bank lenders, and everybody's pointing at everybody else and saying, your fault, right? It involved off balance sheet, it involved fraud, it's a case study. You could write a whole textbook on First Brands, right? And, it's not like it's just limited to private lenders because there were bank lenders involved. It's not that it's just limited to factoring because there was direct lending, there was inventory lending. So there was a bunch of products that we typically see in the market all impacted, right? Really, First Brands went from its debt trading at, or even its B debt trading at like 90 cents, 80 cents on the dollar, to bankruptcy in about 30 days. That's how quickly things deteriorated. Ultimately, the problem in First Brands was a liquidity problem. Yeah, well, it was fraud, but putting
that aside for now.
Putting that aside,
right?
But what caught up with them is, they bought the inventory, overbought the inventory to escape the tariffs or to get ahead of the tariffs, and then they just couldn't, they could not keep backfilling the hole, and eventually the hole got so big that everything collapsed with the liquidity. That was First Brands in a nutshell. First Brands had a traditional asset-based lending facility to First Brands. Then they had AR purchasers who would buy directly the receivables from First Brands, supposedly in true sale off balance sheet transactions. They also had with their buyers had supply chain facilities which reverse factored the receivables due from First Brands. And then they had off balance sheet inventory financings where they financed in various SPVs inventory. So there was a lot going on there. They took invoices and double, triple pledged them to the AR purchasers. Sometimes they pledged the same invoice multiple times in different amounts, and nobody seemed to know about it. And, aside from the AR purchasers really not being able to get up in front of the bankruptcy court and identify what they purchased, I mean, the indictment was just released last week or 2 weeks ago against the principals of First Brands, and the government makes the point that one of the AR purchasers in 2023 points out to First Brands and says, hey, look, you sold me the same invoice twice. One was for, I don't know, $100. The other one was for $100,000. Something's not adding up here. Yet that purchaser 2 years later, still purchasing from First Brands. So, you got to wonder what was going on in their mind. And, a lot of the purchases were platforms, tech-enabled platforms. And right, they were platforms for other people. So you got to wonder if that had something to do with it.
So as a lender, like what are some big takeaways, things that they could learn, like what not to do? Was it just like pure negligence, or was there what?
Well, the road to hell's paved with good intentions, right?
Right.
So it works until it doesn't. That's part of it. It's like anything else. We all know when you buy an invoice, you're supposed to buy the invoice. Everybody knows there are occasions where, well, we're going to lend on unbilled, and then they'll get me the detail, right?
Right.
Well, it's not really an invoice. We do everything by email. We kind of put everything together, and we all know what the price is. So nobody starts out saying, I'm going to buy fake invoices or I'm going to, buck the trend. But there's always a reason it starts out in a direction it does. And then it snowballs. That's like every fraud, right? And then it snowballs. It gets bigger and bigger and bigger. So, the takeaway is, yes, do your diligence, verify your invoices, make sure you have the invoices. We know it's always not that black and white, but you got to be mindful of what you're doing. I think one of the other takeaways from this is I don't know why the AR purchasers did not talk to one another. I don't know why. They weren't in the same facility, so you could tell me they had no reason to talk to one another. I know at least with my clients who purchase receivables, not like they may not talk to the other guys every single day, but they know who the other purchasers are, and they're in contact with them. I think one of the takeaways that we took out of this is be very careful when you're negotiating your contracts and your NDAs that you're not prohibited from talking to other folks in the cap stack.
Yeah.
Right. Now, I don't know if that was an issue there, but it did make us think that we never want to be prohibited from talking to other people in the cap stack for that reason.
Yeah.
Now, it's interesting you brought up the cap stack because, when I look at First Brands from an outside perspective, especially given, that a lot of M&A activity, a lot of businesses right now are PE owned. So basically the name of the game in private equity is, to some extent, let's again put aside the fraud. First Brands was something of a darling in the fact that they were building this massive business and they were leveraging this. If the leverage is available, you kind of have to, you feel like you got to go after it because, again, that's the way you boost return on equity or return on investment for investors. Is you've got to be as slim as you can on the equity and take the debt you can. And I say all of that to bring up the question, and I think you and I were talking about this before the podcast. Do you feel like that this is just is this an overall structural issue because so many people in the market, especially for PE-backed businesses, they're pushing for heavy leverage? Is that the problem? Or do we feel like this is, and again, I think this is what's most useful for other lenders who are watching this to get a feel for. Do we feel like this is a systemic issue in the market that lenders need to be aware of? Or do we feel like this is more of a one-off, that there was just a confluence of very bad events and that created this happening?
I think it's a little of both. Let's take the leverage for a second, right? Definitely over-levered. Although they're calling the receivables transactions in First Brands factoring, right? Factoring, as we know it, is intended to provide liquidity, right? That's what it is. They already had the working capital facility with B of A. So those receivables transactions were not really they were supposed to provide off-balance sheet treatment to make the leverage ratios look better, right?
Right.
They started to they morphed from that into liquidity. So effectively what you had is at least two liquidity providers on First Brands. You had the ABL facility, you had the AR purchasers, right? As a factor, you really wouldn't be in there. You wouldn't go into your borrower and provide a factoring facility when there's an ABL facility right next to it. Like,
right.
Why would
no,
right.
Exactly.
Maybe fit within a carve out, or but for the most part, you're not providing liquidity when somebody else is. So that's what happened there, right? I think the other part of that is, it's a testament to traditional underwriting and traditional banking.
Right.
From what I understand through my industry contacts, a lot of people did look at First Brands in the past year, and they really couldn't get past square one. So the people who were in there were in large part stuck there. Underwriting, talking to the other folks in the cap stack, and really making sure you have an understanding of the business. I still think right now, even with the indictment, it's not 100% certain how the ABL lenders and some of the other lenders didn't look at the cash flow and realize it doesn't necessarily reconcile with the financial statements. So that I'm sure that'll come out in good time, but that's part of it, is you got to do your homework on the company, on the business itself.
Mm-hmm.
So I feel like more, again, fintech has its place, but it feels like it's more of an indictment of, or maybe not an indictment, just an affirmation of the fact that blocking and tackling never goes out of style.
I think that's a fair assessment of it. Yeah.
I like that. Never heard that one before.
Yeah.
So keeping on the same trend, but a little bit, moving to bankruptcies, are you seeing more workouts and bankruptcies? As of recently, do you plan on seeing more? What does that look like?
So there is distress in the market today.
Mm-hmm.
And again, I don't think it's a market trend or overall trend per se. It's more transaction borrower specific, right? Bankruptcy is not cheap. Chapter 11 is not cheap.
Mm-hmm.
You have to have money to file for Chapter 11, and you have to have a plan, because the bankruptcy judge is in Chapter 11. He's really not going to let you go in there and use his or her court and rack up all this expense without having a plan. So bankruptcy is not cheap. In the lower to lower middle market, there's few companies who truly can afford a real Chapter 11.
Mm-hmm.
Maybe you have a pre-pack or pre-arranged Chapter 11 with a plan, we're going to be in and out. Maybe. You still had to pay for it, right? So the name of the game these days, especially in the lower middle market, is out-of-court restructuring, whether that be consensual, Article 9, but that's a different type of a workout than a bankruptcy, right? You got to understand that arena. For specialty lenders, if you understand that space, there's a lot of opportunity there for you, right? It's just maneuvering that space. You get a discount to maneuver it. So there's great opportunity there. In my mind, I think that trend is going to continue in 2026. You're going to see more of those opportunities. And for the lenders who are comfortable in that space, you can make a good, make good return. You can even actually, tack on some equity to it if you're interested.
But that's a big if, though. Are the lenders comfortable in operating in that space, though?
Yes, big if. Not everybody is, and not everybody should. Right. You have to have the background, the stomach, and the understanding of it. Like, it's easy to say on paper, hey, look, we're going to sell this company in an Article 9 sale and shed this debt, this liability. Who are you going to sell it to? Who's going to run it? Right? Like, what's the game? You got to know how to run a business. So the lenders who want to partake in that space need to know how to run that.
Well, you've got to run a business that's already failed once.
Yeah, that's right.
Basically.
You got to have a plan. You got to know what the problem was and how you're going to get out of the problem and what you're going to do to make it go away, go forward. That's right.
So to get on the right side, I guess the if in that, basically it sounds like what you're saying is really about experience.
Yes.
It's about just having a good attorney, obviously.
Yeah.
Anything else that's kind of the secret sauce when it comes to that in your experience?
Well, to your point, there are some lending shops who have those personnel who are very good at that. They understand exactly what they have to do to get from point A to point B. They understand how to budget for it. They understand how to run that failing business, right? But if you're just, a lender looking for an opportunity without that experience, you don't have the network to do it. You don't have the restructuring personnel. You don't have the turnaround personnel. You don't have those hard money buyers who are going to go in there and buy that from you and take a chance at that business. You need a network of people who play in that space to do that.
Mm-hmm. Makes sense.
Yeah, and kind of to branch off of that, outside of bankruptcies, what just general sense in the space, what do you see? Is there a common theme between lenders that are successful versus lenders that kind of fizzle out and fail? Is there a common trend that you're easily able to identify?
Proactive. The lenders, factors from the bottom of the market to the top of the market who are proactive always do better, right? Mm-hmm. Hope and prayer is never a good strategy. Very.
It's worked for me so far.
Let's edit that.
As a CFO, not what I want to hear.
Hope and prayer seldom works. Those who are proactive always work out better than those who don't. Look, you can go back to First Brands. Had those AR purchasers started insisting on invoices 2 years ago, before the tariffs hit, before it became that over-levered, they might have avoided a lot of the losses they incurred, right? So it's proactive. There were warning signs. There were warning signs 2-3 years ago in First Brands that for whatever the reason, people ignored or, ignorance is bliss, right? you got to be proactive. And I know it's annoying because let's be honest, a lot of the times things happen. More times than not, it does work out okay, right? It does. But when it doesn't, it snowballs. And,
Right.
Someone's always going to be looking back and saying, well, you could have identified it here. You should have done this. And in some respect, they're right. We could have, should have, but we didn't. So the lenders who are proactive about it, they tend to work out better. And from a documentation, a legal perspective, that means you got to, document the defaults, document the waivers, because the one thing you don't want to do is get to the end of the line and realize you haven't papered everything.
Yep.
So it looks like you kind of just pulled the plug willy-nilly.
Mm-hmm.
You don't want to be that person.
Are there other controls or habits that tend to protect lenders?
There are. I think one of the biggest things you can do is look at the payables, in my opinion.
Right.
Asset-based lending, factoring, while we all like to say we are collateral-based lenders, and that's fine, that's true. The reality is that you are impacted by the business, right? And a lot of the stuff that goes wrong, whether it be an MCA, whether it be over-levered, liquidity, you can see by looking at the payables, looking at the bank statements, and understanding the way the cash moves.
Mm-hmm. Yeah.
Yeah, I mean, because you if you're buying the invoices, you better see a corresponding drop in the payables, because otherwise that means the money's going
100%.
flowing out somewhere else where it shouldn't be.
That's right. That's right. And that's true across the board for any business.
Right. Yeah, as an accountant, I mean, one more question. I mean, as an accountant, I have to ask this question, but is there anything boring but critical that you feel like we need to be doing a better job of as an industry?
I think your mileage may vary, right? Since I represent you guys a lot, I think you guys do. I think you guys do a great job of it, right? I think we kick the tires. One of the things I will say that I like about working with you guys so much is it's more than one opinion, right? It's not what you say, what I say, what Jen says. Everybody chimes in on it. Everybody's got an opinion. And I think when you do that, you kind of get to the right place, you flush it out a bit, and there's multiple perspectives on it. I'm not so sure it's like that in all shops. It isn't a lot, but it's not like that in all shops. And, to some extent, it does weigh you down a bit. It does maybe take a little bit longer. And some of the fintechs sell the opposite of that. But having multiple perspectives on it, in my view, gets you to the right place.
Mm-hmm.
Great.
Yeah. Kind of I know we were able to hit on a number of different topics, but just kind of to close it up, wrap it up, is there any advice that you would want lenders, in 2026, words of advice, tips, tricks, you name it, anything that you would want to leave them with?
Well, I think you've already started to see a bit of it in 2025. I think in 2026, you're going to see more opportunities for private lenders to collaborate with bank lenders. Mm-hmm. Right. And you're seeing more and more of that these days. I also think you're going to see more private lenders collaborating with each other once it grows, to avoid losing that deal to a bank lender. Right. So the advice I would have for lenders is essentially look for those opportunities, be open to partnering with other lenders, and, let's take stock of the past 12 months and let's all realize that underwriting is important. You can't skip the underwriting phase. We don't close and then underwrite after we close. Right? Don't skip the underwriting phase. Do the traditional homework that you have to do, but there is opportunity out there. So don't be afraid to jump into the market, but make sure you jump in with your eyes open.
Mm-hmm. Yeah.
Awesome.
I like that. Well, Jeff, thank you for
thanks for having me.
Yeah,
always
I feel like
to be on and get to talk to Jen, especially.
And Jim, obviously, thank you so much for joining us. Could you tell our viewers and listeners where to find you if they want to get in touch with you with any questions or representation?
You can reach me at james.cretella@blankrome.com. or my cell phone, 203-571-9394.
So just giving out the cell phone. I love it with the guests. Yeah, that's all business right
your
there.
Number.
That'd be great. And to our viewers and listeners, thank you once again for joining us on another episode of In Focus with Haversine Funding. Remember to stay informed, stay inspired, and stay on course to growing your financial platform. Until next time.